Warren Buffett stepped back as chief executive with $373 billion in cash and 13 straight quarters of selling behind him. Not a typo. $373 billion. Sitting in Treasury bills. Not deployed. Not invested. Waiting. And for 13 consecutive quarters, every single quarter since mid-2022, Berkshire sold more stocks than it bought. On January 31st, 2026, after 6 decades running Berkshire Hathaway, Buffett handed the chief executive role to Greg Abel and became chairman. So the question is not whether Warren Buffett lost his conviction. The question is, what did he see that made him spend the final chapter of his chief executive career building the largest cash reserve in corporate history? Today we go through exactly what he sold, what he kept, what he bought instead, and what all of it means. One thing before the trades, Berkshire Hathaway is not a fund. It is a conglomerate over 200 operating businesses generating tens of billions in cash flow every year. BNSF Railroad, Geico, Berkshire Hathaway Energy. The cash keeps coming regardless of what the stock market does. On top of that, a publicly traded stock portfolio worth approximately $274 billion. The top 10 positions make up approximately 87% of that portfolio. And on top of that, $373 billion in cash. So when Berkshire moves, even a small shift represents billions of dollars. And for 13 straight quarters, the direction has been the same. Sell, collect cash. Wait, Buffett sold down the stock most people thought he would never touch. Apple. At its peak, the Apple position was worth approximately $170 billion, the largest single stock holding Berkshire had ever built. Then Berkshire started selling. Quietly at first, then significantly. By the end of 2025, Berkshire had sold approximately 75% of its Apple position. The remaining stake, still worth approximately $57 billion, remains the largest single equity holding at around 18% of the portfolio. The clearest explanation is not that Buffett stopped believing in Apple. It is that the position had become extremely large, the valuation had become less attractive, and Berkshire preferred to lock in gains and build flexibility. Bank of America tells a similar story. Buffett invested in Bank of America during the financial crisis in 2011, a classic distressed value bet. He generated tens of billions in profits over the following decade. By mid-2024, the position had grown so large through appreciation that it created genuine concentration risk. He started reducing it systematically, quarter after quarter. The message across both sales is consistent: when a position grows too large and the price stops making sense, even a great business you trim. Now, the part that surprises most people, after selling Apple and Bank of America, Berkshire did not rotate into other stocks. It bought Treasury bills, short-term United States government bonds, the most boring investment on the planet. Berkshire parked hundreds of billions in short-term Treasury bills, turning patience itself into a multi-billion-dollar income stream. Why? By Buffett's own preferred valuation lens, the market looked extremely expensive by late 2025. So instead of forcing money into overpriced stocks, he chose to wait. There was simply nothing large enough and cheap enough to justify deploying the cash pile. So the cash pile kept growing. Not everything was sold. 4 positions Berkshire held through everything. American Express, approximately $50 billion. Owned since 1991. A toll booth on consumer spending with pricing power that is extraordinarily difficult to replicate. Coca-Cola, approximately $26 billion. Held since 1988. Original cost basis approximately $1.3 billion. Buffett has never sold a single share. The dividends alone now exceed the original purchase price every few years. Chevron and Occidental Energy, businesses with strong cash flows that work across economic cycles. Berkshire owns approximately 28% of Occidental outright. The pattern across all 4: durable competitive advantage, predictable cash flows, businesses that will be doing roughly the same thing in 20 years. No AI hype. No hypergrowth, just businesses that print cash reliably and have been doing it for decades. While everyone else was chasing AI and momentum, Berkshire bought very selectively. But it did not stop buying entirely. Berkshire added to its positions in 5 Japanese trading companies: Mitsubishi, Mitsui, Sumitomo, Itochu, and Marubeni. Diversified industrial conglomerates trading at low valuations relative to their earnings. Classic Buffett: boring, cheap, cash generative, ignored by most investors. Then in the last quarter of 2025, in what turned out to be one of Buffett's final moves as chief executive, Berkshire initiated a new position in the New York Times. Approximately 5 million shares. worth approximately $352 million at year-end. A legacy media company that has reinvented itself as a digital subscription platform with nearly 13 million subscribers. A newspaper, not an AI stock, not a chip company, a newspaper with a subscription mode. And in March 2026, already under Abel's leadership, Berkshire made a $1.8 billion strategic investment in Tokio Marine, Japan's largest insurance company. Not just an equity bet, a full strategic partnership covering reinsurance and global acquisitions. The pattern across all of it durable businesses with pricing power, global scale, and cash flows that work across economic cycles. No momentum, no hype. Just businesses Berkshire wanted to own for a long time. But here is the key point. These selective buys, the New York Times, Tokio Marine, Japanese trading houses, did not come close to offsetting the cash that kept accumulating from Apple and Bank of America sales. The message was not buy nothing. It was buy only when the setup is unusually compelling. And right now, almost nothing is compelling enough. Greg Abel did not inherit a company. He inherited a fortress balance sheet and one of the largest war chests in corporate history. $373 billion in cash. A $274 billion equity portfolio. Over 200 profitable operating businesses. And a corporate reputation that makes Berkshire one of the first calls any large company makes when it wants to sell. In March 2026, Berkshire resumed share buybacks for the first time since mid-2024. Abel personally bought approximately $15 million of Berkshire stock on the open market. Berkshire has deployed fortress balance sheets before. In 2008, while markets were collapsing, Berkshire deployed billions into distressed assets at crisis prices. The returns were extraordinary. $373 billion is a significant amount of dry powder. The only question is what pulls the trigger. Now the other side. Because it is real. Cash earns interest, but it does not compound like equities. Berkshire's 2025 returns trailed the S&P 500, partly because hundreds of billions were sitting in Treasury bills rather than deployed into equities that kept rising. If markets stay elevated and keep climbing, the cash pile looks like a missed opportunity rather than a masterstroke. There is also the succession question. Buffett built Berkshire over 60 years. Abel has been in the role for months. Whether he can identify and execute acquisitions at the same level is genuinely unknown. And concentration risk runs both ways. Apple remains approximately 18% of the equity portfolio. If Apple faces a serious business challenge, the portfolio feels it hard. Here is the cleanest way to say it. Buffett did not panic. He did not chase. He sold what looked expensive. He kept what still looked durable. He parked the rest in cash and collected billions in interest while he waited. $373 billion sitting in Treasury bills is not a sign that Buffett ran out of ideas. It is a sign that he still knows exactly what he is doing. If the market breaks, he looks prepared. If it keeps running, he looks early. Either way, $373 billion says he is waiting for something.